Hey folks, welcome back to the channel. I recently had some time to look over the history of the stock market, and I've discovered a new pattern that I think is going to help me. So I'm going to share what I've learned today. Maybe you'll find this pattern interesting and useful as well. Basically, what I did was look at the S&P 500 going back all the way to June 2020, so that's about 3 years. And specifically, I only looked at the days where the stock market, I'm going to use SPY here as an ETF that you can buy and sell. So there's three criteria that I was looking for. One is the market on a daily time frame has to be going up, and we can tell it's an uptrend because of the 9-day exponential moving average, which is represented by this green line. The price doesn't have to be above the green line, but the green line does have to be sloping upwards. The second criteria I was looking for is that it is a green candle. So that just means the stock market finished the day higher than it opened at. And the last criteria is the bottom wick has to be longer than the upper wick. Now, sometimes you just have a whole body and not much in terms of the top and bottom wick. That's fine. But the only rule is the little tail that comes down from the bottom has to be longer than the one on the top. And I wanted to see if there was any patterns for what would happen the following day if those criterias are met. So I basically went through TradingView day by day for the last 3 years and counted up all the times when a green candle closed with a larger wick on the bottom during an uptrend. How many times the stock market went up the next day and how many times it went down the next day. So for the period that I looked at, I counted a total of 170 times or 170 days where those criteria were met. And out of those 170 days, there was 104 days when it was up, and there were 66 days when the following day the market went down. So if the stock market's movement were completely random, then you would expect it to be more of a 50-50 split. But instead, we can see that actually 61% of the time, the market does go green the next day. And by green, I mean it goes up, not necessarily it's a green candle. So I thought that was kind of interesting because I can use it as a screener to say like, okay, when the market closes a green day and the wick on the bottom is larger than the wick on the top and we're going in an uptrend, then there is a 6 out of 10 chance the next day will be positive. So I just figured this out like this weekend. But had I used it for the last couple of weeks, I think the results would have been pretty good because let's see how well this would have worked out over the last couple of weeks. So this is looking at the daily chart of SPY and let's just say the beginning of this month. So June 1st right here. Okay, so let's see. This one, it's a little bit hard to tell, but the bottom wick is a little bit longer than the top. If I draw like a thickness for the top, and then move that to the bottom, you can see it's just a little bit sticking out there. So that was once where it fit the criteria. And then we'll move on, not this one, not this one, this one here. Let's see, I think it also meets the criteria. The bottom wick is a little bit longer. So that's another day. And then this one as well, the bottom wick is longer than the top wick. This one also on June the 12th. And then finally, this doji on the 14th. Just a few days ago. Okay, so just in this month alone, there was 1, 2, 3, 4, 5 instances where the criteria was met. According to the data I've gathered, about 3 out of the 5, or 61%, should have returned a positive day the next day. So let's look at the outcomes. Close up, yay. The next one here, unfortunately, closed down. The next one here, it worked even though the following day was a red candle. You can see it still closed higher than the close of the previous day, which means that was an up day for this instance. And then the next couple of times, the market also went up the following day. This one went up a lot. So out of the 5 instances where that criteria was met, it looks like 4 had positive outcomes instead of 3. So 4 out of 5 or 80%, which is even better than the 61% I have here. Now, there are limitations to this pattern. Obviously, because for one thing, I've only looked at this for the past 3 years. So if we were to take this back to 20 or 30 years, this may get closer to 50%. And of course, like 6 out of 10, that's pretty okay odds, but it's not as good as like a 70 or 75% chance that you could get if you were looking for some other patterns. However, because this is something new that I did not know before, I'm going to try to incorporate this into my SPY options challenge. And the way I'll use it is whenever I notice this criteria playing out, then what I'll do is place an options trade for the following day with a bullish bias. Theoretically, 6 out of 10 trades that I make will go right, and the other 4 will go wrong. And then overall, if I do this enough times, these particular set of trades that I make should overall return positive. If I sell bull put spreads, so for example, let's say this day over here, the market closed at 433.8, we'll say 434, because strike prices, you have to deal with whole numbers. So what I'll do is maybe sell an at the money put spread, meaning I will sell a 434 put option expiring the next day over here on June 13th in this case. And then I will buy like the 433 put option for protection. And the idea with this is the following day, if the stock market closes up, then I shouldn't have to touch any of these options. They would expire out of the money. And if the market goes down, then I will close my position on the next day on the 13th for a loss. The other bullish trade I can make is to buy a call option or a call option spread. That has potentially more upside, but then theta decay is working against you. So I'll probably experiment with each of those different strategies whenever I see this kind of signal playing out. And that'll just be another tool that I can use for my SPY options. Speaking of my options challenge, I was really busy last week and I didn't put out an update. So I'm going to give the update right now. The previous week, I was down $51, and then for this past week, I'm up $316. So overall, my total return for the SPY challenge is about 21%. I was only up 1% this week. Meanwhile, the S&P 500 itself was up 2.2%. So that's quite impressive. As you've been following the market, you would know like this is the last 5 days. Very green here. And if I look at the weekly chart for the SPY, you can see this is the fifth straight green weekly candle in a row. But we are seeing signs of exhaustion because here you can see the top wick is longer than the bottom wick. Even on the weekly chart, I think this pattern plays out similarly as well, just from my first impressions, because you can see this weekly candle here has a longer bottom wick, it's a green candle, and the 9 weekly EMA is going up. So the next week it's positive. And because the next week also has that same criteria, the following week is also green. But of course, it doesn't always work because you have this candle over here that has all 3 criteria, but the following week it was red. So I'm less sure about the weekly, but definitely on the daily, if those 3 criteria are met, then there's a higher chance the next day will be positive rather than negative. And in terms of what happened just this past Friday, I made a trade near the end of the day. This is for Friday. So about an hour before the market closed, I sold a bear call at 441, 440. And basically, I wanted SPY to finish the day because this is a 0 DTE trade expiring at the end of that day on Friday. So I wanted SPY to finish the day below 440. And the reason I put that in is because right around here, so 305 is when I put the trade in. I was bearish over here because SPY has broken the lows of that day. So usually when the market goes up and down, it tends to be range bound, and then whichever range, either the top of the range or the bottom of the range, breaks first is where a lot of people are going to get their stop losses triggered. So that's why you see this like big drop down right after SPY fell below the previous low of the day. So that's when I sold the call option, being bearish, and SPY eventually finished the day below 440. So that spread expired out of the money. So that's going to be it for today. I will try to implement this pattern into my new trades and see how that goes. I'll keep you guys posted, and good luck with your investments and trades as well. Thanks for watching, and until next time.